Hello, everybody, and welcome to this weekly market recap for the week ending January 10th, 2025. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you again this weekend. Obviously, not a very good week in the market last week. We closed on some lows, had the non-farm payrolls report come out on Friday. I think the market was reacting to that. I'm not sure that they reacted correctly to that, but I do think they were reacting to that. And we saw some bearishness in stocks, as well as bearishness in the bond market. A lot of folks selling bonds, which was driving the yield up higher. So we'll take a look at that chart and what triggered some of that selling in bonds and the stock market. But let's go ahead and take a look at the action from last week. So let's start here with 1 week return on our major indices. You can see transports actually held up the best, losing just 0.5%. On the other end of the spectrum was the Russell 2000, the small cap index, along with the NASDAQ 100. Those were the two weakest indices. The Russell 2000 dropped about 3.4%. The NASDAQ was down about 2.25%. If we move to the sectors, energy, we had three sectors that actually were higher last week. Energy gained a little over 1%. We had crude oil prices rising throughout the week. That certainly helped. Healthcare was up about 0.5%, still remaining above that key 136 to 137 level on the XLV. If you look at a long-term weekly chart, you'll see that was a prior resistance level. We went through it, got up to about, I think, 150, and then pulled all the way back down. We've been challenging right around that 136, 137 level. We've done that a few times now, still trying to bounce off of that. So from an absolute price standpoint, I still think healthcare looks fine, even though when you look at it on a relative basis, it has been a lagging group. And that's the case, obviously, with a lot of these different groups, is we're seeing some relative weakness, but absolute price charts do still remain trending to the upside, which I think is encouraging. To the downside here, you can see real estate, again, weak, dropping more than 4%. I know there's been a lot of talk this week and over the recent several weeks, maybe going back a month or more, that inflation, we can't lose sight of inflation. In fact, that inflation is likely to pick back up again. I'm not buying into it. I continue to watch the charts and I try to see where money is going. Real estate's a hedge against inflation. So those who are really concerned about inflation should be pouring into real estate. We're not seeing that, with real estate down 4% last week. So, and the worst performing group. So I don't see money flocking into hedges the way we normally would see if, in fact, we had an issue with inflation. So again, the way everything sets up for me, we saw a lot of the aggressive groups last week, kind of in the middle of the pack. Communication services, consumer discretionary. We had industrials. All three of these groups losing much less on average than, say, real estate. Technology did have a rough week, along with financials. But technology, I still think, from a longer term perspective, looking at the chart, still looks very strong. And that's 32% of the S&P 500. So again, I'm still having some issues buying into what a lot of folks are trying to sell here, which is that the stock market's going to go down due to inflation. The 10-year treasury yield. So I don't want to ignore what's going on in the market. I look at these charts. The 10-year treasury yield's been rising. It could be rising for one of two things. It could rise because the market's concerned about inflation and investors require more of a return if there's an inflationary issue out there. The other reason, though, is it could be going up simply because the economy remains resilient and strong. The jobs report came out on Friday. It did show the jobs were higher than expected, which I think still is it's a bullish thing for the market. But if you are in the camp of worrying about inflation, you could look at a higher jobs number than expected and maybe start to think, hey, that's going to have inflationary impacts, which would drive the yield higher as well. So I get both arguments, but when I look at what's going on in the rest of the market, the inflation story just doesn't add up. So anyway, we'll talk a little bit more about that as we go through these various charts. I wanted to pull up this employment situation. This is over at econoday.com. And if you pull up non-farm payrolls from Friday, this is what you get. Here was the number that everyone was reacting to. The non-farm payrolls came in at 256,000. You can see the consensus estimates were between 125 and 200. So this was outside even the most bullish analyst calls on payrolls. This came in higher. So I understand some of the trepidation from this report on Friday. Consensus estimates were only 157. I will say, though, that the prior 227,000 jobs was revised lower to 212,000. So that was a little bit to offset. Unemployment rate dropped to 4.1%, which I think is always a good thing. I don't want the unemployment rate to get out of hand. Once we get over a hump, and really start to see that unemployment rate surge, it's really difficult to avoid a recession. So I think it's good to see the unemployment rate come back down. One thing that really I didn't hear much of was the fact that manufacturing payrolls actually dropped 13,000, which was lower than anyone was predicting on the consensus range. So that was kind of going against the fact that this was a really hot report. Manufacturing payrolls actually came in below the entire consensus range and well below the consensus number. Average hourly earnings continue to come in 0.3%. So even though the jobs market seems like it's still pretty strong, we're not seeing anything that's out of the ordinary in terms of average hourly earnings. That works out over the course of the entire year to be about 3.6%. You can see that the prior was 0.4, so we're at least heading in the right direction there. The average hourly earnings year over year dropped to 3.9% actual versus consensus of 4.0. So there were some, there's a little bit of a silver lining in this report as well. But no doubt the reaction that you saw on Friday with yields jumping, stock market selling off, has to do with the 256,000 jobs that were created and the way the market was spinning it, the way the media was spinning it. And again, I just say that because the market wasn't reacting like they were overly concerned about this high number. And again, we'll talk about that in just a moment. First, S&P 500. S&P 500, we did close below the lowest closes in terms of this neckline, lowest close or lowest high, or excuse me, lowest open. So any candle bodies that we saw leading up to this neckline test, we actually moved below on Friday. So I can sugarcoat this a lot of different ways if I want to. Technically, though, that was a breakdown, and we did see it on increasing volume. So we'll need to see what kind of confirmation we have going forward. But in the short term, at least on the S&P 500, you should at least consider that this is if not a confirmed breakdown, certainly pretty darn close. Like I said, the number's a little bit below. It wasn't a huge red candle. You can see we did come off the lows a little bit, but it was slightly below that neckline. So got to report it as it is, and that was technically a breakdown. We do have gap support that comes in a little bit below 5,800. I think it's also important to look at other S&P 500 charts. And on the weekly chart, we have seen multiple times in 2024 where we have gone down to the 20-week moving average. Even on one occasion back in early August, we went slightly below it. We gapped down below it, but then we came back up by the end of the week. So we have not had a close below the 20-week, a Friday close below the 20-week moving average since all the way back in October of 2023. So that's about 5 quarters, 15 months. And so we'll see how this all plays out. But at least for now, on a weekly chart, we closed at 58.27, the 20-week EMA 58.26. So we closed less than a point above that 20-week moving average. And again, we've done that before. So I'm not going to write the market off, and especially given some of the other things we see going on. But that, it's a negative. If we go down next week below the 20-week moving average, that would be another negative, technically. All right, looking at the S&P 500 another way, still got the same price chart, but let's take a look at those sustainability ratios. And this is where I'm just not buying the inflationary argument, because these ratios should be dropping rapidly if the market is worried about inflation. You don't want to be in growth stocks in an inflationary period. We saw that back in 2022 when inflation took off. The growth stock area of the market got pummeled. So take a look at what's going on here. Here's the QQQ versus the S&P 500, so the QQQ versus the spider. We had a spike in mid-December. We pulled back late in December. We've opened up this year, even though we're slightly lower on the S&P 500. This growth ratio, QQQ versus Spider, is slightly higher, and I argue still in an uptrend off of that low in September. Consumer discretionary versus consumer staples been in an uptrend now for about 5 months. We're barely off the 52-week high. So again, why isn't Wall Street moving into consumer staples? Why are we still holding up on consumer discretionary? That shouldn't be happening. We're seeing reactions that would suggest maybe inflation's a problem, but not here on this chart. Growth. So I look at 3 different asset classes. We'll look at the large caps, mid caps, small caps. Growth versus value. Large caps still sitting up here pretty nicely near the high. Mid caps. In January, we've been pretty strong in terms of growth versus value. Small caps, look at this jump in growth versus value. Again, this doesn't make sense if inflation is a problem or expected to be a problem. Wall Street would be rotating out of growth stocks. Growth stocks get hammered with inflation because inflation eats away at future earnings. And growth stocks they're not valued based on their balance sheets. They're valued based on their growth and their rates of growth. Inflation eats into that. So as soon as you start worrying about inflation, one of the first things you do is sell growth stocks. Not happening on a relative basis. Now I'm going to keep watching. If all of a sudden we see a big, huge drop here, then yeah, that's something more that would be leaning towards inflation being a concern and something we'd be wanting to make sure we're well aware of in terms of investing in the stock market, how we want to invest. Do we want to invest at all? But right now, these charts aren't showing that to me. So you can listen to the media if you want, or you can listen to where the money's going. I mean, you can take your choice. I've stated many times which one I listen to. NASDAQ 100. So we got the head and shoulder top on the S&P 500 that I'm well aware of and I've been watching. But off of this uptrend, what do you call this that I'm going to be annotating here? Because as you have highs that are coming down faster than the lows are going down, you actually have what kind of looks like a little piece of a pie that's forming. This is called a wedge, a bullish wedge. Now you don't confirm it, just like a head and shoulders, you don't confirm until you get a breakdown. A wedge, you don't confirm until you get a breakout. So you got to watch this top channel line. But if the NASDAQ starts to move back higher and gets through that 21.5, 21.6 level, it would start to paint a picture that, hey, this was nothing more than a period of consolidation and we're off and running again. So watch for that to the upside. Downside, I think you've got this gap support and the recent low in mid-November. That's where I'd be watching to the downside. All right, IWM. So IWM small caps, listen, I'm still a fan. The story is still alive as far as I'm concerned. But you can't ignore short-term choppiness and breakdowns. And that's what we have right now on the IWM and on the small cap area. Notice the failure at the 20-day moving average, and the 20 is below the 50. You can call this whatever you want, but this is a bearish configuration on a daily chart. Now, I say a daily chart because if we look at the weekly chart, you will see that we're still hanging. The 20-week is still above the 50-week. And back in early August, we threatened that 50-week moving average, did not close below it. We're kind of sitting almost on a relative basis, kind of like we were back in early August. So I still see an uptrend in play on the IWM from a longer term perspective, but clearly we see some short-term weakness. So what we need to see is we need to see this reverse itself. We need to see the IWM get back up above about 226. And until we do that, it's kind of hard to argue bullish things on this chart. We can be aware of the bullish long-term chart, but on a daily, things don't improve until we actually change the daily chart to start looking more bullish. To the downside, I think 214, 215 is an area that I would watch very, very closely on the IWM. If you go back into October, that's where the lows were back then. We got down to about 218 recently. We went below that on Friday with that non-farm payrolls number. And so I would be watching 214, 215 to the downside and about 225, 226 to the upside. As far as I'm concerned, that's the range we're in on the IWM. And until we break one way or the other, it really isn't giving us a signal which way. I think, again, daily chart, you have to respect this, but you also have to respect price support. So we've gotten a lot of tests here down around this 214, 215, 217, this whole area in here, and that's where we are again. So do we hold that? If we don't, then it definitely starts to open up some things that don't look as good on the weekly chart. 205 all the way down maybe to 197. Get to the weekly chart, the 20-week moving average right now, or the 50-week moving average is at 211. So we don't really want to see those levels, 207, and certainly not below 200. That would have us back below the 50-week moving average, which would not be a good sign. All right, let's take a quick little break here. Talk a little bit about earningsbeats.com. If you're new to Earnings Beats, love to have you come over. We do have a free newsletter down below. You can sign up for that, name and an email address. It's a newsletter that comes out twice a week. It's very quick. It's a chart in 2 paragraphs. Would love to have you. We have tens of thousands of folks that have signed up for it. Again, it's completely free, no credit card required, so you can check that out. Recently, though, we did the Market Vision 2025 event. We are now selling the recording with pretty cool bonuses. So if you click on that, it will bring you to this page where you can claim your copy. You got 2 options. One is just to get a single session, which includes my top trading tip for 2025. If you get that, you'll get a 30-day free trial. You'll have to obviously sign up with using your credit card for that, but you will not be charged until the end of your 30-day trial, and we'll remind you. So this is a great way to kind of see what we do at Earnings Beats, but then also get this recording and all of it for free. So you can do that, or if you would like to get a copy of our recording, the live event was $797. We've cut $100 off for the recording, and you still get the major bonus that we were offering back right before the Market Vision 2025. So you'll get 1 year of our membership for free. That's a $997 annual value. So by paying $697, you're going to get that $997 value, and you're going to get this recording, which I think the recording is worth it, the $697 all by itself. Anyhow, you can check that out. If you're on a mobile device, you've got a QR code that you can scan on the screen right now. That also will take you to this landing page, and you can sign up via your mobile device. All right, a couple more things before we wrap up. I did just write an article at Stock Charts. So if you click on that, actually, if you go to articles at the top here and click on it, this is what comes up. All of the latest articles from me and a lot of the other contributors at Stock Charts, they will be shown here in just chronological order. If you do click on my article, one thing you'll see over at the right-hand side over here is you can see the drop-down menu of all the various blogs. Just below that, you can follow my blog by simply putting in your email address and then clicking that submit button. And what that does is anytime I publish an article at Stock Charts, I only publish one or two a week, but when I do, they'll immediately be sent to your email address. Stock Charts doesn't use these emails for anything else, doesn't sell your information. We never sell your information. If you ever sign up at Earnings Beats for using your email, we keep all of that private, as does Stock Charts. This is simply a convenience over at Stock Charts. So if you pull up the article, an article of mine right over here to the right, you should see follow this blog, put your name, or excuse me, put your email address in there, hit that submit button, and then you will get all of the future articles that I write. Couple things. I wrote about the fact that the Dow has been underperforming the S&P 500, and I wanted to just show you a couple charts here, and then we'll wrap this thing up. But first, the Dow Jones, you can see this is the absolute chart. Obviously, been going straight down now for about 5 weeks. If you look relative to the S&P 500, the Dow Jones has been on a straight down spiral as well. And so the whole article was just trying to help everyone understand what's going on with the Dow Jones. Well, one of the things that's going on with the Dow Jones is you have to understand what or how the Dow Jones value is determined. If you look at the S&P 500, that's a market cap weighted index. So it's very simple. the largest market cap companies in the world, Apple, NVIDIA, Microsoft, and so forth, they have a tremendous impact on where the S&P 500 goes. And you'll hear a lot of folks talking about the Mag 7. Those three stocks are three of those seven stocks. You've also got Meta, you've got Google, you got Tesla, and I'm missing one other one, Amazon. So you got those seven stocks that really help drive the S&P 500 and the QQQ, even more so the QQQ. Well, when you look at the Dow Jones, it's not market cap weighted. It is price weighted. Whichever company has the highest price, share price, those are the stocks that are most heavily weighted. So let me show you what I'm talking about. So I created this chart list, Dow Jones components, and I have it in order of the highest ranked or highest percentage. What am I looking for? Representation. The most representation, the highest representation within the Dow Jones. I've got it in order, top to bottom. And if I pull this up in view all, so let's go up to the summary. What you can see here is I'm going to put it in name order. Here's the price of the stock. So Goldman Sachs is the highest weighted stock in the Dow Jones. United Healthcare is number 2. Microsoft, one of the Mag 7, is number 3. Then Home Depot, then Caterpillar, then Sherwin-Williams. Now, we can put let's put the market cap and the scooter score over here for a second. So you can see Goldman Sachs, $175 billion company, and it's ranked number 1. You could go down here, though. Here's Apple, $3.58 trillion, and it's only 3.61%. Goldman Sachs is more than double the weight of Apple in the Dow Jones. So we're not seeing the same kinds of relationship in terms of those highest weighted stocks. Microsoft is up there because it has a $418 price, but Apple is much lower because it's only a $236 price. This column right here, which is showing you the price, the percentages are in the same order as the price as you go down this list. So you get all the way down to Verizon, it's only a $37 stock. It only carries 0.5% of the Dow. Even though, I mean, it's got 159 billion, it's not the smallest company. Here's 71 billion, that's 3M. There may be some others that are down there as well. Travelers, 52 billion. It's 3.4% because it's the stock price. So it's a little different in how it's weighted. But if you look at look at these top names right here. These are the ones that are weighted the highest in the Dow. Look at how they've performed yesterday, Friday, and then also I'm going to go back a month and look at how these stocks performed over the last month. These are the biggest stocks. If you go down toward the bottom, a lot of these stocks toward the bottom really didn't do that badly, but they're not weighted much. So look at the ones, 11%, Sherwin-Williams, almost 10%, Caterpillar, Home Depot, 7.75%, United Health, almost 8%. These are stocks that are getting absolutely hammered, and they're among the most heavily weighted. So if you want to know what's going on with the Dow Jones or how the Dow Jones is going to bounce back, you got to look at these top 6, 7, 8 stocks and what they've been doing to the downside. You need them to reverse. That's how the Dow Jones will outperform again. Also, if you look at the scooter scores, that's the stock chart's technical rank, you'll see that there are 5 in a row here where the scooters are below 60. And so this is kind of a relative strength indicator. So it's telling you that these stocks are not showing very good relative strength, yet these 5 are 5 of the 6 highest weighted stocks in the Dow Jones. So you've got stocks that are not performing very well in the near term that are driving the Dow to the downside. So if you want the Dow to move up, you got to look at these 5, 6, 7 stocks, look at their charts and watch for them to break out. When they do, they get back up above moving averages and so forth. That's when you're going to see the Dow Jones start to lead again. Anyhow, that's all I got for today. I really appreciate you tuning in. Thanks so much. If you are a new, viewer, welcome. If you've been around for a while and you've been following us for a long time, we certainly appreciate all your loyalty and support. Please like the video below. Also subscribe. Those things help us as far as the algorithms go at YouTube. So we would love to continue to build our community here on YouTube. And try to provide useful information, not just what the media wants us to know from some, scary headlines and so forth. So if you like the show, again, please hit that like button, subscribe to the channel, and keep following us here at Earnings Beats. So again, for the team at Earnings Beats, I appreciate all of you, and we'll be back next weekend to do it all over again. Happy trading.